Thanks very much, Dan. As Dan says, I'm slightly the odd one out here, as I'm not from an investment trust. As Dan says, my name's Tom Selby. I'm a senior analyst at AJ Bell, the investments and pensions company, and I'm just going to talk you through a few tips for your ISA and your pension as we move into the new tax year. Just a quick risk warning there. I think that was covered off at the start, so I don't need to go over that again. The things I'm going to cover off today. So firstly, a very quick slide on the spring statement, because there wasn't anything particularly interesting in there, quite frankly, from a personal tax perspective. I'm then going to look at some of the new things that you need to expect from the 2018-19 tax year. So that's from April this year. I'm then going to look at some of the pension tax things you need to think about as you're saving into a pension. There's some bear traps and some quite complicated things around something called the taper that you might need to be aware of if you're a higher earner. And then finally, cheerily, I'm going to end on death and pensions, but it's all useful stuff, I promise. So the spring statement, we were promised that it would be a non-event, and it actually was a non-event. So for pension savers, that was good news, certainly in my time in pensions since around 2009. Pretty much every single one of these big set pieces from the Chancellor has been preceded by speculation of whether tax-free cash was going to be abandoned or higher rate tax relief was going to be taken away by the Chancellor in some big tax grab. None of that this time. A slightly longer speech than expected, a couple of references to Winnie the Pooh and Eeyore and things like that, but generally it was a non-event. We got some very much a focus on macro issues from Chancellor Hammond. So one thing that savers may be interested in was the slight downward revision in the expectation of inflation going into 2018-19, 2019-20, potentially good news for savers, also potentially good news for borrowers if the Bank of England reacts to that by keeping interest rates at a current low level. In terms of pension tax relief, still incredibly attractive for savers across all income tax brackets. So if you're a basic rate taxpayer, so the example we've got here is £10,000. It only costs you £8,000 to get that into your pension. If you're a higher rate taxpayer, you can claim another £2,000 back. So it only costs you £6,000. Additional rate taxpayer can get that £10,000 into a pension for just £5,500. Now, we'll have to see what happens at the budget later this year. I think that's probably going to be in November. Inevitably, there will be speculation because there'll be tax and spending decisions to be made then. But at this time, pensions remain a very attractive savings vehicle for your retirement. One minor change which we may be getting is to the EIS regime. So there may be a little tax boost for knowledge-intensive enterprise investment schemes. It's only a consultation at this stage, so whether or not that comes through, we'll probably find out later in the year. So what's new for 2018-19? So I'm going to quickly run through some of the new things that have changed. This is just a change north of the border. So if you live in Scotland, Derek Mackay, the Scottish Finance Minister, announced in December that Holyrood are going to use wide-ranging powers that they have in order to in order to set differential tax rates for people in Scotland versus people in the rest of the UK. So what does that mean? Well, we've got the different rates up here, if I just use my pointer. So we're going to have a new starter rate. So that's just above the personal allowance between £11,850 and £13,850. So that's £2,000, set at 19%, so slightly lower than in the rest of the UK. We've then got the basic rate, which is a truncated band versus the rest of the UK, still set at £20,000. That's up to still set at 20%. Sorry, that's up until £24,000. We then got a new intermediate rate for £24,000 to £43,000 of earnings, and then we've got a new higher rate of tax at 41%, so 1 percentage point higher for people in Scotland, and the additional rate band has gone up to 46%. So again, 1 percentage point higher. Overall, the Scottish Government suggests this is going to result in anyone who's earning around £33,000 or less won't pay any more income tax, so it's the higher earners who are going to bear the extra tax as a result of this. In terms of pensions, there are some knock-on implications for people north of the border. So if you're at those lower levels, then you should automatically get your tax relief at 20%. So that means the 19% taxpayers and the 20% taxpayers won't have anything to do. It will be exactly the same. As you move further up the wage levels, intermediate rate taxpayers will be able to claim back an extra 1% of tax relief because they still get it at their marginal rate. Now, one question that we're going to ask is whether or not people will actually bother to do that, because quite frankly, for those people, it'll be quite a small sum of money, but we'll come on to that. Higher and additional rate taxpayers in Scotland are just going to have an extra reason to save in a pension because they're paying a higher rate of income tax. The tax relief on offer for them will be 1 percentage point higher in each case. So yeah, looking at that intermediate rate tax band, I mean, first, this is just more complexity north of the border. I don't think any of this is particularly helpful for anyone, but there are little opportunities here. So again, if you're Scottish, around 900,000 people are going to fall into this tax band, and they'll have a decision to make as to whether or not they want to claim their extra 1%. If you look at the example here, so someone earning 30 grand who wants to save 10% of their salary in a pension, go through the maths, and you end up with that extra 1% of tax relief will be around 30 quid a year. They'll have to go through the process of filling out a tax return. A lot of these people won't have filled out a tax return before, and whether or not people are going to do that or not is open to question. I think pragmatically, I would expect that certainly nowhere near that 900,000 people will do that, but if you had that £30 invested over a period of 40 years, so a normal working life, then it could be worth somewhere close to £4,000. So not a trivial sum, but people are going to have to go through the work of filling out a tax return in order to get that 30 quid. The dividend allowance, so a separate issue now. The dividend allowance introduced by former Chancellor, now newspaper editor George Osborne, was introduced at £5,000. So that means obviously you can earn £5,000 of dividends without being taxed on that money, particularly popular for business owners who like to pay themselves in this way. Also relevant to investors who've got dividend-paying investments. Now, Chancellor Hammond, so George Osborne's successor, decided that that was far too generous. So from April this year, the dividend allowance is going to be cut by 60%. So that's from £5,000 to just £2,000. Now, that's going to make quite a big difference to anybody who's got investments that are paying them dividends, or anyone who pays themselves through dividends. We can see, so we see here, I mean, at the basic rate, the tax on any excess above the dividend allowance, 7.5%, not too bad. When you get into the higher rate, 32.5%, and the additional rate, 38.1%, you can see that anybody who's getting taxed on their dividends above that £2,000 is going to be feeling some serious pain. In terms of the impact that could potentially have on your own investment portfolio, so if you think of £5,000 invested in this tax year versus the next tax year, so sorry, £5,000 of dividends, then you'd be paying an extra 225 quid if you're in the basic rate band, an extra 975 quid if you're in a higher rate band, and over a grand if you're in that additional rate band. So these can be avoided because this is just dividends that are paid outside of tax wrappers, so in things like general investment accounts. So if you want to avoid that extra tax, it's worth reviewing your investment portfolio, looking at any unwrapped investments you've got, and considering whether it's worthwhile putting those into something like an ISA or a SIP, where any growth and dividends are tax-free. Separate issue, so you may have heard of automatic enrolment. This is a program that's been rolled out since 2012, so it's gone through it was introduced by a Labour government, it's gone through coalition, and it's remained in place. The aim of auto-enrolment is to get the whole nation saving for a pension. Generally, the reforms have been reasonably successful so far, so we've had about 10 million new savers entering a pension scheme. All employers now have to offer you a pension scheme at a low level at the moment of matching contribution of just 2%. You may have seen the adverts as well, this weird furry monster is called Worky, and this is the more recent one. Clearly, 2% isn't very much, so what's going to happen now is the government's going to increase that minimum contribution. So anybody who's employed is going to see more of their wages going into a pension scheme automatically where they're enrolled at the minimum level. Worth noting that the calculation of the contribution is based on a band of earnings. Nothing simple in pensions, so rather than it being based on your entire salary, it's based on your salary between £5,876 and £45,000. So the new thing from April this year is the minimum contribution goes up to 5%. So that's 3% from the worker, including tax relief, and 2% from the employer. Moving into 2019, so one year from April, we'll see it go up to 8%. So that'll be 5% from the employee, including tax relief, and 3% from the employer. There's also plans in place. It's quite vague at the moment, but sometime in the mid-2020s, the program's going to be expanded, so younger people are included. At the moment, you've got to be 22 or over. It's going to be reduced to 18 years old, and they're also considering scrapping that earnings band we talked about so that every pound of contribution receives an employer-matched contribution as well. Just quickly looking at the impact of this change, so the change that's coming in from April, if we think about somebody who's earning £27,000, so that's just below the average age in the UK at the moment, their personal contribution, so that's excluding the employer matched contribution and tax relief, their personal contribution is around £169 a year. From April this year, that's going to rocket up to 517 quid, and then from next year, it'll be up to £879. Now, to put that in context, you need to think about what the annual total contribution is. So that's just the money that they'll see coming out of their pay slip. Down here, you see what goes into the pension through tax relief and the matched employer contribution. So it's a decent amount. However, it's going to be a test for the reforms because, as you see, someone earning 27 grand will see from their own payslip, they'll see go from 14 quid a month going out to 43 quid a month going out, and then from April 2019, it'll be going up to 73 pounds a month going out. So people are going to have to make a decision about whether or not that's a worthwhile investment for them. The message that I've been trying to get across to people whenever I've been speaking to them is that you need to think of this as deferred pay. So employers have to make a decision about the amount they're going to spend on each employee's remuneration, and they've known this has been coming down the track. In reality, most employers have already factored this in to the amount that you're paying you at the moment. So if you choose to opt out of an auto-enrolment pension scheme, you're effectively taking a voluntary pay cut. And the start reality as well, as you see at the bottom here, is that the minimum through auto-enrolment isn't going to get you very much. So if you look at that £27,000 earner, if they're paying at the minimum for the rest of their life, that'll get them to about £218,000, depending on the investment assumptions that you use. That'll buy you an annuity worth somewhere shy of £8,000. Add that to the state pension, you've got a total income perhaps of £15,000 or £16,000. Now, for some people that'll be fine, that'll be enough for them to live on in retirement, but a lot of people will be more ambitious than that. So if you want to have a pension pot worth more than that, then you need to think about paying in over and above that auto-enrolment minimum level. Right, going into some of the complex pension tax stuff that you need to be aware of. I mean, I'm not sure if Einstein would struggle to understand our pension tax system. That's probably not fair. I think he'd struggle to understand the logic of the pension tax system. I don't think anyone in their right mind would design a pension tax system with 4 different allowances and 3 different annual allowances that people need to understand. But that is what we have, and that's what I'm going to quickly talk you through now. So we've got a lifetime allowance, fairly straightforward, although some protection in there you need to be aware of. An annual allowance, so that's the one that most people are affected by. A money purchase annual allowance, which affects anybody who's accessed their pension through the pension freedoms. And the tapered annual allowance, which is just horrific. But we'll quickly go over those different allowances just so that you're at least aware of them. So the lifetime allowance, first of all, that's something that's been subject to a lot of change over the years. So at the moment, it's set at £1 million, so obviously the amount that you can save in a tax incentivized environment throughout your lifetime, set at £1 million, due to go up by 30 grand in April this year, and then it will carry on going up in line with inflation. Now, the lifetime allowance has been treated as a bit of a cash cow by different chancellors, certainly since 2010. So it was 1.8 million back in 2010. It was then cut back to 1.5 million, then cut back again to 1.25 million, and then down to £1 million. Now, the result of all those cuts was the creation of a load of really, really horrible protection regimes. The reason, the reason they were created was to make it fairer for people. So if anyone had built up above what the new lower lifetime allowance was going to be, then it was only fair they still got to retain the higher level. But what you end up with is quite a complex mess of a system, which, frankly, most financial advisors do quite well out of because they're able to advise people on this really complicated stuff. But for individual investors, it can be quite difficult to navigate. A couple that you may need to be aware of, indeed, if you're lucky enough to have built up a big enough pension, you may even have one. So we've got the Fixed Protection 2016 regime. So Fixed Protection 2016 allowed you to lock in to a £1.25 million annual lifetime allowance. You don't have to. Your pot. There's no minimum on fixed protection for the size of your pot, so it can be any size. But the key thing about fixed protection is you can't make any more contributions after April 2016 once you've locked into it. Now, that's potentially a danger because of auto-enrolment. Some people may have got fixed protection on the £1.25 million pot, then still be working, get auto-enrolled by accident and not realise that they'd bust that fixed protection, and as a result could be lumbered with a tax bill of tens of thousands of pounds, even possibly over £100,000. So if anyone here has got fixed protection, then first of all, well done for building up such a big pension pot, but second of all, make sure you don't get accidentally auto-enrolled into your pension scheme, because it could cost you a hell of a lot of money. Individual protection, so slightly different regime. So under individual protection, if your pot's worth more than £1 million in April 2016, then you lock into your own personalised lifetime allowance. So it'd be somewhere between 1 million and 1.25 million. The difference between that and fixed protection is that you can carry on contributing into a pension and benefiting from that employer contribution. I appreciate that you all managed to stay awake during that bit. I'll try to get onto some slightly more interesting stuff. The annual allowance, so the annual allowance is currently set at £40,000, as you expect. That's the amount that you can save each year, tax-free into a pension. No change for 2018, which is good news. That applies to most people, so it'll apply if you haven't accessed your pension flexibly from age 55. It'll also apply provided you have adjusted income below £150,000 and or threshold income below £110,000. Now, those two in particular are related to the annual allowance taper, which I'll get onto in a moment. If you breach the annual allowance, the HMRC will simply reclaim back the tax relief that you have received. A quick tax tip. So if you are, again, we're talking about higher earners here. So if you're lucky enough to be able to pay in £40,000 into a pension each year, and you actually might be paying in more than £40,000, then it's potentially you could potentially have a higher annual allowance. So there are rules called carry forward, which allow you to use unused allowances from up to 3 previous tax years, bring them into the current tax year, and enjoy an annual allowance of up to £160,000. So that'd be 3 times £40,000. Brought over plus the £40,000 that you've got in this tax year. So if you're going to make a really big pension contribution over £40,000, it's possible you could still do that in a tax incentivised way. Money purchase annual allowance, again, particularly one of my most hated of the recent changes. So the government introduced pension freedoms back in 2015, which essentially encouraged people to access their pension flexibly, to go into drawdown or to take as much or indeed all of their pension as a lump sum if they choose. If you do that, then your annual allowance will be reduced massively. So it'll go down from £40,000 to just £4,000. So the message I'd say anyone should take away from this slide is if you've not accessed your pension flexibly yet and you're thinking about doing it, just take into account the impact it's going to have on your ability to save from that point. I think a lot of people will be wanting to access their pension to pay for long-term care for relatives, or perhaps to help put their kids through university and things like that. You need to be careful about the impact it's going to have on your ability to save. One way to get around that is the MPAA, so the money purchase annual allowance, only applies when you take taxable income from your funds. So if you just take your tax-free cash, so just take your 25% tax-free cash from your pot, then you'll still have a £40,000 annual allowance. The tapered annual allowance, now I'm coming close to the end of my time, so I'm not going to be able to go into detail on this, and I think that's probably a relief for everyone. Extremely complicated. I'd say speak to a financial advisor if you think you're affected by this. The one thing I'd say, I think the slides will be available if anyone thinks they may be affected by this, because there's clearly a lot of numbers and some detail in there that you won't be able to see. The one thing I'd mention is that this adjusted income calculation here and the threshold income calculation here, so if you're above those two things, so if your adjusted income's above £150,000 and your threshold income's above £110,000, then your annual allowance will be reduced by £1 for every £2 you earn above the adjusted income level of £150,000. Now, income in these two things doesn't just include your salary. It includes all forms of taxable income. So it'll be things like dividend income, if you've got a portfolio of properties that you're receiving rent from, any kind of income will be added to that amount. So if you think you're going to be getting more than £150,000 from those sources, it's worth sitting down with your accountant or with your financial advisor or whoever, working out exactly what you're going to be getting, what kind of income you're going to be getting this tax year, and whether that's going to restrict your ability to save in a pension in a tax incentivized way. Quickly, so the rider, death and pension taxes. Benjamin Franklin, in this life, nothing can be said to be certain except death and taxes. With pensions, that is still the case, but it's a little bit friendlier than it used to be. So It used to be the case that when you died, if you had any pension, any money left in a drawdown pot, then you would be hit with a 55% tax penalty, alongside the pension freedoms, which kind of got most of the hoo-ha and most of the attention. There was some quite helpful changes introduced to the way that pensions are taxed when you die. So as you see here, so now if you're unlucky enough to die before the age of 75, and clearly most people don't want that, the one good thing is that you can pass on your pension tax-free to your beneficiaries. If you die after 75, then tax will be levied at your beneficiary's marginal rate. It makes pensions actually quite an effective IHT vehicle to pass money down to the generations. Money can be passed on as a lump sum, or it can be passed on in a pension, and the way that it's taxed over 75 is something that you need to think about there. So if you pass it on as a lump sum, it'll be passed on. It'll be at your beneficiary's marginal rate of income tax. So if it's a big chunk of money, then they may end up paying more tax than they need to. Whereas if it's left in a pension, then you can drip out the money slowly and potentially reduce the overall tax bill. A couple of important points to note. So again, I know this is quite depressing. So after you've died, your funds need to be designated to whoever the money is supposed to be passed on to within 2 years, or you may end up paying tax that you don't need to. Designated just means it needs to be transferred over into their account. And make sure you. Again, I never like saying this bit, but you need to make sure you review the people who you've nominated to receive your money. Personal circumstances change, people get married, people get divorced, people have kids, and your pension could be the biggest asset you've got. So you need to make sure that the people who are in line to receive it are the people who you want to receive it when you're no longer around. And you need to make sure you tell your pension scheme about that so they know who you're going to get, so your money goes to the right place. So quick summary there, Scottish income tax changes, so a bit of a tax relief boost for the highest earners, and higher and additional rate taxpayers. Intermediate rate taxpayers can get it if they want. Dividend allowance cut, big one to be aware of. Automatic enrolment, contributions are going up, but your extra money in your pension from your employer as well. Watch out for the MPAA, that's horrible, and the taper. If you think you're affected by the taper, then speak to a financial advisor. Death and pensions tax, pensions now an effective IHT vehicle. That's it from me. Thank you very much for listening, and I hope you enjoy the rest of the speakers. Cheers.